Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is The Talking Point, and this is Monday, September 9th. And the futures market is up. Now, I do want to point out, however, the futures market has been a bit dicey and opened up at 6 o'clock Eastern on Sunday night, and it was down and then up and then down. But so it's right now, as I do this call, it is all up, all green. That's all that I'm seeing. But we know that that could change many times before we get to 9:30 this morning, and not to mention where the market goes when we close. But I do want to point out that if we look at which part of the market is technically oversold, it would be NASDAQ. So we're going to keep an eye on NASDAQ to see whether or not we get a nice bounce. We call it an oversold bounce. You've heard me talk about overbought conditions where you're looking for the market to sell off. Now we're looking at a market to give us a bounce as it was oversold. However, I do want to point out that the market is torn right now. And I think everyone knows after last week and Friday when we got the employment numbers, whether or not the Fed is going to deliver a 25 basis point cut on September 18th, or do they go to 50? Now, let me go over this, if I may, in this call. The report that came out on Friday morning at 9:30 Eastern had the expectations had been, the consensus estimates had been that we would have 162,000 new jobs. Now, it didn't come in there. It came in at 142,000 new jobs. And there was concern that we're seeing the labor market little by little by little slowing down to the point that perhaps the Fed should give us 50 basis points for a rate cut. Now, this is what happened. Right after the numbers came out, and that was obviously, at not 8:30 in the morning. What happened was the futures market, we talk about the futures market all the time, the Fed funds futures market. Well, what was interesting is right away, like in about 3 minutes, the CME, that's the group, the FedWatch, CME FedWatch, which has the pattern of changing the numbers of what people think is going to happen at the Fed meeting, each and every Fed meeting, by the way. And it moved very, very quickly when it started to move, that suddenly it was that the Fed was going to deliver, in terms of probability, a 50 basis points rate cut on September 18th, and it just moved right over there. And then it switched again. What made it switch going back to 25 basis points as the probability in the FedWatch, CME FedWatch group? It had to do with a rethink, so to speak, about the numbers that we actually got. And I'll get to that in a second. But we had two Fed speakers. One was the head of the New York Fed, and he pointed out, it's time for rate cuts, obviously, because Chairman Powell said we're going to have rate cuts, basically. He said it at the Jackson Hole, Wyoming conference. But he didn't get into, the head of the New York Fed, he did not get into specifics. Then Christopher Waller, who came in. Christopher Waller is known as a hawk, meaning, look, I want to see inflation gone. So we're going to raise rates. And remember, he even said when he talked, I think it was at 11 o'clock a.m. on Friday, he said, I'm the one that said we need to front load higher rates. We need to do it because we got to get rid of inflation. So what he said was interesting. He said, if we need to cut rates, a bigger rate cut, he said, I'll say we need to go big if we need it. However, he pointed out that let's be gradual about it. And then suddenly what we saw happening was the futures market shifted from 50 basis points back to 25 basis points for September 18th when they're going to make the decision. And as I do this call, I looked it up, and we're still very much in the camp in terms of probability of 25 basis points. Now, here's the thing. The issue is obviously Chairman Powell. The issue is when the Fed meets, remember, they met and they made the decision on July 31st not to cut. But there were, according to the minutes, several members who suggested that perhaps it would be a good idea to think about and perhaps cut rates on July 31st. So there are those who believe that the labor market needs help because remember, this is the Fed's maximum employment mandate. It's not about inflation. It is about the labor market and the health of the labor market. So the question for the market is, and for the Fed, let's remember that, and for the Fed, they're grappling with this. They're going to spend a lot of time debating it, whether or not they come in with 50 basis points or the 25 that the market now thinks is going to happen. The question becomes, is this, were the numbers that we got on Friday horrible enough to say, hey, you know what, we got to go in and cut more than 25 basis points? So let's look at that. First of all, what bothered the market and really scared the market was that there were two downward revisions. The 2 months before this report, there were two downward revisions. You know what? Market doesn't like two downward revisions because the fact of the matter is when we look at, periods where things got really weak for the economy, you always saw downward revisions, unless, of course, it was a shock, something that hit the market, and it was a shock to the market system, so to speak. So that was one thing. And then the consensus estimates were for 162,000 new jobs. And what did we get? 142,000 new jobs. So it was much lower than expectations. Now, here's the other thing. Estimates were that we were going to see the unemployment number come down from 4.3% to 4.2%. And that happened. So that was a positive. The unemployment rate came down. Another thing that was positive, wages inched higher. Not dramatically higher, but they were higher overall. And that's a good thing. And you don't see wages going up if, managers, you think the economy is failing and the economy is going to do poorly. They don't raise wages. And right now we know that folks are working and they, are worried about their jobs and they're not going to go be pushing for higher wages if they're worried about their jobs. So it indicates that managers felt comfortable enough to raise wages. And again, it wasn't dramatic, but it was higher. And then the other thing, and that is the work week expanded. And this is important very often, and we've seen it over these last numbers of months where the work week actually weakened. How many hours did we work? In this report that we got, the work week expanded, which is a positive. And so this is where the debate is. Is it really so horrible? Is it a real major decline or is the labor market normalizing? Is the labor market normalizing to where we were pre-pandemic? And that's the dilemma for the Fed. This was not clear-cut, and that's why the debate between now and September 18th in the media, because, by the way, the Fed is in the blackout period. Christopher Waller's comments were the last thing the market heard from a Federal Reserve official. And remember, he said, look, if we need it, we will go in with a larger rate cut. But he said, only if we need it, we prefer to be gradual. So then, again, it leaves the market hanging. Well, what we know is there will be a debate. And the question is, how would the Fed characterize a 50 basis point cut? What would they do to keep the market from saying, oh my goodness, the Fed is worried about the economy. The Fed is nervous about the economy. They could use a term that's been used before when the Fed comes in with a bigger cut, and they talk about an insurance policy just to make sure that the situation doesn't deteriorate. And that's how they could do it. Now, would we be warned by what they're going to do because they're in a blackout period now? Most likely not. The fact of the matter is that the Fed very often says, and you'll hear officials talk about this, they like to surprise the market with rate cuts. They like to surprise the market with a deeper rate cut. However, now this is where it gets dicey. That would be great if it had to do with inflation coming down at perhaps a faster clip. but not so fast that it made the market worried about a deflationary cycle and the economy slowing too quickly. But let's just say, for the sake of argument, that it came down and it really surprised the market in a positive way. The Fed could come in and surprise the market with 50 basis points cut. There's an old saying that the Fed likes to do that because they get more bang for their buck when they surprise the market. But in this case, and we've been over this, the market doesn't want an emergency cut. They don't want to hear that, oh my gosh, we needed 50 basis points because guess what? Things are deteriorating. Because suddenly everyone's going to think recession. And the market, as you all know, doesn't want to hear and even think recession. The market wants the Fed to cut rates because inflation is coming down. A good thing. So this is the dilemma. And the fact of the matter is, when I look at the futures market, actually for November, so we're talking about September, but when I get to November, it looks as if the Fed, according to the futures market, may give us a bigger cut. They have the ability to do that, especially if the labor market deteriorates at a faster clip. And I do want to point out, the Fed could come in any time. They don't have to wait for a meeting. Now, would it scare the market? Yeah, of course it would. But nonetheless, the Fed is going to do what it has to do for the economy, not for the stock market, but for the economy. And let's always remember that. That is their focus. So there you go. The number that came in actually followed what we heard from the ADP report that came out on Wednesday. And that was lower than expectations. And remember, when we have our report, the payroll report on Friday, that includes government jobs, which the ADP report does not. So if we just take away the government jobs that we had in the Friday report, actually it follows very closely with the ADP report. And by the way, in terms of government jobs, I took a look at that, and a good portion of that was actually state and local governments. So all in all, it's a slowing. It's not collapsing. And again, to repeat the positives, wages were a bit higher, not tremendously so, but higher, and the work week was expanded. I want to make clear that's why this is difficult, because we could turn the page and have it all negative if we want to, with the revisions, downward revisions, a lower headline number, and so on. In any case, overall, last week, the market was also worried about technology. What it was worried about was this. Are companies going to continue spending at the pace that they spend it? Remember, just for the second quarter, the hyperscalers, that's the term that's used for the Microsofts, the Alphabet, Meta, Amazon, the ones buying all of the infrastructure for artificial intelligence, AI, or generative AI. They're called the hyperscalers. They spent $60 billion altogether in capital expenditures in the second quarter. Are they going to continue with that, or are they going to hold off a little bit? And are they going to hold off in order to just take what they have and try to get it integrated into their systems? So this is a dilemma for the market. And the market is now, you'll hear many folks say, well, AI just got ahead of itself. It got ahead of itself. Well, generative AI is not going away. Surely it could slow down, let companies absorb it, and see how they do integrating it in order to come out with products that actually include it. Now, here's the thing. We're going to hear from Apple, and Apple is going to be talking about their new lineup, and their new lineup for iPhones, a new lineup for iPads. This is their Pro group. Also, they are talking about, and they want to show how they have been using generative AI in their systems. And the market's going to be paying very close attention to how they have been doing it and whether or not it warrants the expenditures that the companies are budgeting for. So that's really what's happening now, a question mark. In addition to all of that, we have seen the shape of the market skewing more defensive. Look at consumer staples. Look at healthcare. Look at financials, for example. I know financials sold off, and that had to do with the worry that perhaps perhaps the labor market is weaker than they thought, because that's something they don't want to see happen. And we won't go into it on this call, but we're going to keep our eye on the market this week and take a look at the strength of a bounce. Take a look at which sectors lead. We saw semiconductors sell off. We saw technology sell off. Let's see again if they get the bounce that we think they'll get. Again, because the NASDAQ and especially triple Qs were down so dramatically. So this is an important week for the market. And remember, we're not going to have any Fed speakers unless, for example, the Fed thinks it needs to send a message to the market. They've done that before during a blackout period. They can do it again. But nonetheless, as I said, right now, the market is looking at it and saying, okay, maybe it is only 25 basis points because maybe it's not so bad. And maybe things are okay. They may not be great, but they may be okay. I always look at it this way. Not stellar, but certainly solid. In terms of what we're going to have this week, let me just point it out. The big event, as everyone knows, is the Consumer Price Index, the CPI. And you'll see some of the headlines and the chatter in the markets. Well, it doesn't count anymore, right? You hear that the Fed is not worried about inflation, not at all. And all they're worried about is the maximum employment mandate. Well, think again. I mean, expectations are that inflation continues to come down. But let me tell you, if those numbers surprise to the upside, in other words, a hotter than expected report, that's going to throw in another element for the market and saying, well, what can the Fed do? What are they going to be able to do? Are they going to keep rates? Are they not going to cut? I don't think you're going to see that. I just put it in there as a off-the-wall chance that you could see it's hotter than market expectations. Right now, that's not the expectation at all in the consensus estimates. It's actually that inflation continues its climb lower. So that will be a good thing. And remember, we don't want it down so fast that it looks deflationary. Not at all. We just want it to come down in a smooth path down, and the market's expecting that. Also want to add that tomorrow on Tuesday, we're going to have the National Federation of Independent Businesses, the Small Business Owners Optimism Survey. I like this very much because America is made up of small businesses. Small businesses are the backbone for our country. They are the biggest employers in the country, and I want to hear what they have to say. And I'm also going to pay attention if they're still talking about inflation. Have prices risen? And the reason I'm mentioning this is that last week, the Purchasing Managers Report, the PMIs, the ISM, Institute for Supply Management, Manufacturing Report, and Service Sector Report, had prices inching higher. Prices received, prices paid, and they would like to actually raise their prices in both the service sector and the manufacturing sector. So I want to see whether or not prices are going up, and I want to hear if the small business owners are talking about it, because you'll see what they're saying in that optimism report. It's very important, as is, by the way, the PPI. People say, oh, it doesn't matter, Quincy. Yes, it does matter. The Fed does not want to make a mistake, and that report is coming out after the Consumer Price Index. That's the PPI. It's the Producer Price Index. It's, in essence, the path towards the final prices of manufacturing. So a lot for the market to digest in just a couple of macroeconomic data releases, but very important. We are at a very important point for the market, and we want to hear everything that we can get and knit, so to speak, to get a clearer picture of our economy. It's an economy that's slowing, but again, it is not collapsing. Please remember that. We'll be back next week. Thank you all so very much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.